Good morning, everyone, and thank you for joining in for this webinar on hedging strategy, FNO hedging strategy. Firstly, let me introduce myself. My name is Tarang Solani, and I am the product manager of derivatives in HDFC Securities. And I will be the host for this session. I will take you through various hedging strategy, how to play in this volatile scenario, how to play the hedging strategy. We'll take you through various hedging strategy. As there is some network disturbance, I would just like to switch off my camera if it's fine with you all. So there are various hedging strategy where you can play upon in this kind of a volatile scenario. So we'll just quickly have a glance upon various hedging strategy, because in this kind of a market is very much necessary, where you need to have certain kind of a protection, because there is a lot of whipsaws movement which has been happening into the market. And for that, we need to understand a few of the strategies where we can protect ourselves on the both the direction. So before wasting any time, let us begin about learning about certain strategies. But before jumping into strategies, I will just quickly go through some of the options part. That is what is call option, the basic options part, what is call option, what is put option, and then we will go through the various hedging strategy. Now, taking you through options, there are two types of options: call and put. So if you are bullish, you need to buy call option. If you are bearish, you need to buy put option. I hope everyone would be knowing it. If you want to take advantage of your bullish view, you can take the advantage by buying call option, because once the market goes up, the call prices will also go up. And if you want to take advantage of your bearish view, you can buy put option, because once the market goes down, the put option prices will go up. So if you want to take advantage of your bearish view, if you feel that the market is on the bearish side, you can buy put option to take advantage of it. And once the market goes down, you will make money in put option. And same way, if you want to take advantage of the bullish view, you can buy call option and to take advantage of a bullish view, so that if the market goes up, you will make profit on the call side. Same way, if you want to take advantage of bearish view, you can also take advantage by selling call option. And if you want to take advantage of bullish view, by selling put option. So this we can see it with the example that you will, with the examples, if we start looking into it, you will come to know what exactly the scenario, how exactly the scenario will work. So before starting, can anyone reply on the chat box or question answer section? Am I audible properly? Is my screen visible to you all? Can anyone please reply on the question answer section? Am I audible properly, and is my screen visible to you all? Okay, thank you, Mr. Vishal. Thank you. I got the confirmation. Thank you a lot. Thanks a lot. So now, example of buying call options. This is an example of buying call option. I am bullish on the market. I will make money once the market goes up. So if I buy call option, I will make money, because if the market goes up, the call option prices will also increase. Now, before going ahead with the buying and selling of option, I will make you understand what's the difference between buying and selling of options, because it is very much necessary to understand the difference. Now, if you're a buyer of an option, your capital requirement is very less, limited to the premium which you are paying it. And your reward is unlimited, and also your risk is limited to the premium which you are paying it. But if you're a seller of an option, your investment is quite high. If you sell one naked options, your investment is in the range of 1 lakh of rupees, which is quite high. Your risk is unlimited if in case your view goes wrong, but your reward is just limited to the premium you are receiving it. So let us understand step by step with an example. Now, this is an example of buying of call option. Now, I am bullish on the market and I want to make money out of it if the market goes up. In this scenario, current market price is anywhere around 15,900, 16,000, and I feel on the expiry day, Nifty will go above 16,200. So what I will do, I will buy 16,200 call option at 150 rupees. So here, if I am a buyer of an option, my risk is just limited to the premium which I am paying it, 150 rupees into lot size. That is 50 shares, 7,500. However, my reward is unlimited. So in the payoff graph, you will be able to understand if the market goes down, I won't lose money more than rupees 150 rupees per share. But if the market starts moving up, I will make money, and my maximum profit is unlimited. So I will make an unlimited profit. Now, suppose market expires at 16,500. I will make money of rupees 150 rupees per share on an investment of 150. So double I can make it. So here in just 7,000, 8,000 of rupees, you can enter into the market in a very less capital. Your risk is also low, but your reward is high, since if the view goes right, you tend to make unlimited profit. Now, same way, if I want to take an advantage of, if I have a bearish view that any cost Nifty won't go above 16,500 levels, so I can do it by selling call options. Now here I'm selling 16,500 call option at 100 rupees. So 100 rupees is a premium, and 16,500 is known as the strike price. So I'm selling at 100 rupees. So here my maximum reward is just 100 rupees at the premium which I am getting, that is this 100 rupees into lot size is 50 shares. So my maximum reward is just 5,000 rupees, 50 rupees into 100. So 5,000 is my maximum reward, but my risk is unlimited. If in case Nifty goes starts moving above 16,500 levels, then I tend to lose unlimited. Hence, since your risk is unlimited, your investment requirement to do this naked call option writing is also quite high. You will need approximately 1 lakh of rupees of margin to just sell 16,500 call option, which is quite high, just to earn 5,000 of rupees. So in this payoff chart, you will be able to understand that if Nifty expires on or below 16,500, one would make 100 rupees as a maximum profit. But if Nifty starts moving up and goes above 16,500 levels, the risk is unlimited. So if it expires at 16,800 levels, then you would tend to lose 200 rupees. How 200? 16,800 minus 16,500 is 300 points, and you have already got 100 rupees. So 200 will be the net loss you will be facing it. Now let us understand about put option. Put option is like an insurance policy to make you understand in a better way. So if I am sure everyone would have bought one insurance policy in your life. Now let us take an example of vehicle insurance. So if you have bought vehicle insurance from an insurance company, so against it, what vehicle insurance will assure you, if anything happens to your vehicle or if any damage happens to your vehicle, then I will compensate it to you. The same way, put option is the same thing. Suppose you buy 15,800 put option. So 15,800 put option is an insurance company to you. So 15,000, and you pay a premium to buy 15,800 put option. So 15,800 put option will assure if Nifty goes below 15,800, how much ever it goes below 15,800, I will compensate for you. So put option is like an insurance policy. And also, if you have a negative view, if you are a trader, you can buy put option. If market goes down, then put option prices will increase and you will make money if you have a negative view on the market. And the second way, if you have a big portfolio, we will understand in the various strategy. If you want to hedge your portfolio, or if you want to hedge your big holdings, then also you can buy put option as an insurance. If in case your view goes wrong, then put option will protect you on the downside. So this is an example of 15,800 put option. Now in this case, my view is negative. I am buying 15,800 put option at 120 rupees. So 120 rupees into 50 shares is the lot size. So my maximum loss for this is 120 into 50 would be 6,000 rupees. So 6,000 rupees is my maximum loss if in case my view goes wrong and Nifty expires above 15,800 levels. But suppose if Nifty starts moving below 15,800 levels, suppose Nifty closes at 15,500, I bought 15,800 put option, I will earn 180 rupees if Nifty expires at 15,500 levels. So on the expiry day, I would be earning around more than double what I have invested. So how 180 rupees? So between 15,800 and 15,500, there is a difference of 300 points. Minus 120 is what we have paid. And so difference is 180 what you will be receiving as a net profit. So this is how we calculate. Suppose it closes at 15,000 levels, you will tend to earn 680 rupees per share on an investment of rupees just 120. So this is an example of put option, selling put option. Now I told if you are a bullish to certain extent, you can also make money by selling put option. You know that market could go either direction, but one thing you are sure that market won't go below 15,500 at this level. So what do, you sell 15,500 put option at 50 rupees. Now in this scenario, since you are a seller of an option, your risk is quite high to the premium which you are risk is quite high if in case your view goes wrong, but your reward is just limited to the premium which you have been receiving it. So here I will be gaining not more than 50 rupees per share. 50 into 50 is the lot size, so 2,500 is the maximum profit I would be gaining it. But on the lower side, my risk is unlimited if in case Nifty starts moving below 15,500 levels. So here in this scenario, if Nifty expires on or above 15,500, I will make 50 rupees as a profit. But if Nifty expires below 15,500 levels, I will start making loss. Suppose if it expires at 15,300 level, I will make a loss of 150 rupees per share. So how 150? Difference between 15,500, 15,300 is 200 points, and 50 rupees I've already received. So 150 rupees is a premium. I will be losing it. Now let us now go into the option trading strategies. This is the brief which I have given you the gist of how options work, how call options work, how put option works. Now in this kind of a market scenario, option trading strategies could be a smarter way to participate in market swings. So based upon the market swings, there are huge market swings. So it's necessary to protect your portfolio, to protect your holdings. If you are playing futures, if you are playing in MTF also, margin trading facility, then also it's very much necessary to protect yourself. Now that protection only comes from options because it's a very smart tool to basically protect your holdings. Now how? Let us understand. Now first strategy which we'll be looking out is protective put strategy. Now, what is protective put strategy? Now, to give you a definition, protective put or put hedge, also we call it as put hedge, is a hedging strategy where the holder of a security buys a put to guard against a drop in the stock price of the security. So, as I told, that put is an insurance policy, so it acts as an insurance on your lower side. Since if you're a buyer of particular stock or portfolio, and simultaneously you buy put option, the put option acts as an insurance on the lower side if your view goes wrong. Now, how to create and when to create? A protective put strategy is usually employed when the trader is bullish on a stock but wary of uncertainties in the near term. It is used as a means of protection, as I already made you understand. Now, let us take an example. Suppose you are bullish on ICICIBank at current market price and you buy one future or stock of ICICIBank in cash market segment or in MTF. So at current market price is around 720 rupees, and also simultaneously you buy ICICI put option at 720 strike price at 15 rupees. Now how does this work? Now you have just paid 15 rupees extra. Now here you have just paid this 15 rupees extra to protect give you protection, and hence you have increased your cost by 15 rupees. So your break-even point, break-even point, that is where you will start making profit is above once ICICIBank starts moving above 735. So here on the downside you are protected. Suppose if market goes, ICICIBank goes down, 720 put option will compensate you. If ICICIBank future starts moving up, then you have a future or stock with you, so that will help you to capitalize on your gains. Now, since put option, buying of option require less investment and the risk is just limited to the premium which you are paying it, that's why there is an perfect hedge which is involved, but future the reward is unlimited. So here now your maximum loss, if in case your ICICIBank doesn't move, your maximum loss is you have protected your loss to 15 rupees per share if ICICIBank expires on or below 720 rupees. However, if the profit is unlimited if ICICIBank expires above 735 rupees. So let us understand with this example. So here this is a payoff chart. If in case ICICIBank starts moving below 720 on or below 720 rupees, you won't make loss of more than 15 rupees per share. But if in case it starts moving up, you tend to make unlimited profit. Now suppose ICICIBank expires at 800 rupees. So you will make 65 rupees as a profit by just protecting investment. Now this is just an investment of 15 rupees and not more than that in this strategy. So 65 rupees you can make. How 65? 800 minus their break-even point is 735. How did this break-even point came? because you have bought at 720 rupees and you have paid an extra cost of 15 rupees to for a protection. So your break-even point is 735 now. So at 800 rupees, you will make 65 rupees. 800 minus 735 is 65 rupees as a profit if ICICI Bank expires at 800 rupees. So this is the beauty of your protection. Protective put has been used by many of our smart investors trading in MTF, trading in futures. They in this kind of a volatile scenario, they also buy one put option so that if there are any kind of whipsaws movement, they are still into the market, very much into the market, and they are fearless because they know they have the put option with them, so they can hold for a longer period of time. And suppose if market bounce back or particular stock bounce backs, which they have bought a put option and of stock or a future, then they will benefit from that up move also, because it's very necessary on your down whenever there is any down move in a particular stock. It's very much necessary you should hold confidently, and that confidence will give you only if you have certain kind of a protection in place. Now the second strategy is a covered call strategy. Now let us understand what is covered call. Covered call is a call sold against a long stock or a future position. One will sell a call which should be of equal quantity. So of course, once you do any kind of a hedging strategy, you should make sure that whatever you do should be of equal quantity. And covered call is a strategy where you sell call option against the future or a stock which you are having it. The strategy is to create an extra trading income over time. It also creates a cushion to the downside if the stock sells off slightly. So let us understand. Now suppose you have a Reliance stock with you in your portfolio, or you have bought Reliance futures. Now suppose you have bought Reliance futures at 2500 rupees, and simultaneously you are selling a call option of 2600. Sorry, there is some mistake. 1 second. So here, suppose you have bought one future or stock of Reliance at 2500 rupees, and simultaneously you are selling Reliance call option of 2600 strike price at 25 rupees. So you will be getting 25 rupees at an inflow to you because you are selling a call option. So selling a call option will require an inflow. But if you buy a future and simultaneously you sell a call option, so your margin requirement will also decrease to sell this call option, because system knows that you have already bought a future or you have a future with you. But if you have a stock or stocks with you and simultaneously you are selling call option, then there won't be any margin benefit to you. But you can pledge that stocks against that. You can use that margin to sell this Reliance call option. So that can be done without any bringing in any extra funds. And with HDFC securities, that happens with 0% interest. So what you have to do, suppose you have Reliance stock with you in your portfolio, you can pledge that Reliance stocks against that whatever margin you will be receiving it. You can sell this Reliance call option strike price of 2600. So there is no need to bring any extra funds. And once you sell this 2600 call options, the whatever margin has been received, you can use it, or the whatever the pledge margin you have received it. So without bringing in any extra fund, you can use that margin, and that too with a 0% interest. So HDFC Securities doesn't charge any interest cost if you use this kind of a facility, and this is for all the clients. You don't have to subscribe or anything. It is for all the clients that you can use it pretty much from our system. So here your break-even point is 2475. Why? Because you got a 25 rupees cushion. You have bought 2500 rupees. You have bought one future or a stock at 2500 rupees, and simultaneously 25 rupees is a cushion which you have bought. So your break-even point now from 2500 it will reduce down to 2475. Of course, your maximum loss is limited since Reliance, if it goes down, there is no protection. So if it expires below 2475, your maximum loss is unlimited. However, your maximum profit is limited to 125 rupees per share on or about 2600. So if Reliance Industries move on or about 2600, you will tend to make 125 rupees per share as your maximum profit. How? Because 2500 you have bought a future, 2600 you have sold call option at 25 rupees. So this premium you will be getting it. and difference between your future price and the strike price is 100 points. So 100 plus 25 is 125 rupees is the maximum profit you will be making it, because about 2600 this call option will will have a negative outflow, because since we have sold the call option at 2600, so about 2600 there will be a negative outflow, but we already have a future with us, so it will compensate from the futures price. So what is covered call? This is a payoff of covered call. Here our risk is unlimited. We are just doing it to basically earn premium to reduce our cost. So this is the only motto. If you have this motto, then only you should do covered call, or else if you have a big portfolio with you, which is ideal, and you can also do this covered call strategy against that, because you already have a big stock holdings with you, which is equal to the FNO lot size. You can sell out of the money call option to generate income from it. So here below 2380, that is the loss is unlimited. However, the profit is limited to the extent of rupees 125. So risk and reward, maximum risk, as I told, the price paid for the stock minus the credit received from the short call, that is the risk. Reward is limited to the strike minus the stock price plus credit received, and the break-even point is stock price minus credit received for call sale. So this is just in formula form, which I have already explained you in a theoretical way. Now, when and how to use covered call. Now, this strategy works best when there is a slow upward move in the stock is expected. An expected sharp move in either direction is not good for a covered call strategy. Now, the trader doesn't necessarily have to sell at the money calls if the trader selects the out of the money strike. Now, here we have select the out of the money strike. They will collect less premium, but will leave more room for the stock to profit on the upside. So here we have selected out. This is known as out of the money options 2600. So here we have sold out of the money option, and as we have sold out of the money options, we in future we'll have more room to earn profit from the upside move. Also consider that while covered call may not offer the huge reward potential like other strategies, but they can make money if a stock rallies, trades sideways, or even sells off slightly. This means that covered call can make money in many different market environments. Now, the last strategy which we'll move upon is the collar strategy. Now, collar strategy is nothing but the combination of protective put and covered call strategy. Now, suppose I am a I am a very risk averse traders, and I don't want to take any single rupee risk into the market. Now, if you are this kind of a trader, then you can use this collar strategy. In the collar strategy, your risk is limited and also your reward is limited. So what you do, a collar is a three-leg strategy combination of future or cash market. If you buy any position, simultaneously you are buying put option to protect on the downside, and you are selling call option if in case to basically reduce your cost by buying your put option. So if you're if you buy a put option, there is a premium which you need to pay, but simultaneously you are selling a call option. So whatever premium here you will be getting it by selling call option, you can compensate that premium by buying put option. So net there is not much of extra cost involved to give you a protection. The strategy is designed in such a way that the premium received on the call option will compensate for the cost of the put option. Selling a higher call will restrict your profits on the upside. With put, it also protect you on the downside. Now here, since I told by doing a collar strategy, your profit will also be restricted and your loss will also be restricted. So let us understand with an example. Now suppose I have a positive view on the market. Nifty's current market price is suppose 16,000. So in this scenario, what I will do is I will buy one lot of Nifty future. Simultaneously on the protection, I will buy 15,900 put option, and also so simultaneously, I will buy one lot of put option of 5,900 at 100 rupees, and also sell 16,200 call option at 80 rupees. So net, what is my outflow is just 20 rupees is my outflow. So my break-even point is 16,020 rupees. So just by paying 20 rupees, because here 5,900 put option, you have paid money to buy at 100 rupees, and 16,200 call option you have sold. So here you have received 80 rupees. So net you have just given a protection of 20 rupees by paying just 20 rupees. You have protected on the downside, and of course you have sold the call option. So that's why your profit is also kept on the higher side. So maximum loss for the strategy is 120 rupees per share. Now how 120? Because 16,000 and you have the protection starts from 15,900 levels. So 15,900 put option you have bought. So your protection starts from 15,900. So difference between this is 100 and plus 20 is what is your outflow. So 120 rupees per share is your maximum loss if Nifty expires below 15,900. However, your maximum profit is 180 rupees per share if Nifty expires above 16,200. I'm sorry. So how 180 rupees per share? So 16,020 is your break-even point. I'll just show you. So 16,020 is your break-even point, and if it expires on or above 16,200 level, you will make a profit, that is 16,200 minus 16,020. So 180 rupees is the maximum profit you will make for this strategy. So same way you can create short positions also, collar short, where you can short your position, buy call option to protect and simultaneously sell put option if you this is a collar short strategy. So here as I told, your maximum risk, if you buy one future simultaneously you buy one protection leg and also sell call option to reduce your protection cost. So here in this case 120 rupees per share is your maximum loss, on the maximum profit is 180 rupees per share. So this is a perfect hedging strategy if anyone wants to hedge in a perfect way, where they don't want to incur any kind of an extra cost and they want to hedge. So what they can do is they simultaneously can buy put option and also sell call option on the higher side to reduce the cost of protection. So that was for on the strategy fund. Now who should trade collar? Ideal for positional traders, traders with conservative approach with main objective to limit the risk. Ideal for traders who trade during any event or result announcement where implied volatilities are high, and for conservative traders. Ideally it is for conservative traders. So that's it from our end on the strategy part. We have covered all of the hedging strategies as of now. Now we'll just give you a brief about HDFC securities offerings. Basically, how you can benefit by trading futures and options with HDFC securities. The first and foremost is the flat rupees 20 per order brokerage plan. So doing all these of strategies required lot many legs involved, hedging legs, 2 leg, 3 leg strategy. So for that you need to have a brokerage plan which is quite low. So we have come out with a flat rupees 20 per order brokerage plan. So if you don't have this brokerage plan, first you check what is your brokerage plan with you. If you don't have this brokerage plan, you can avail this our derivative value plan. That is, I'll just give you the link post the webinar. So in this derivative value plan, you can opt for this brokerage plan of rupees 20 per order. So 20 per order gives you a facility. If you buy one lot in a single order or buy 10 lots in a single order, then also flat rupees 20 would be charged to you as a brokerage plus tax. Now this brokerage plan is of 199. Derivative value plan you have to pay just 199 plus tax, which is an annual charges. Just 200 rupees not only will get this brokerage of rupees 20 per order, but also will get a free access to a pro terminal, which is advanced trading portal, which is our advanced trading portal. So firstly, if you don't have a brokerage plan of rupees 20 per order, subscribe to this derivative value plan of rupees 199 plus tax, and you can get an access to rupees 20 per order as a brokerage with a free access to pro terminal also. I post this webinar, I will just copy and paste this link so that you can subscribe for it. And also one more interesting fact which I will like to share with you, that there is a 0% interest on derivative margin. I've already explained you in our one of this option trading strategy which we have been discussing about. So this zero interest on derivative margin, what it is. Now suppose you have shares in your portfolio, and you pledge that shares against that whatever margin you are receiving, you can avail that margin in derivatives market. So suppose you don't have any extra any funds with you, you can still play into futures and options by pledging your shares from the portfolio, and against that whatever margin you are receiving, you can avail that margin by trading in derivatives market without any interest. So yes, there is no interest cost which you will be incurred by doing this facility, and this is for all, where you don't have to subscribe to any link. It is for everyone. You can directly go into your web-based portal or your mobile application, pledge the shares, and once you get the margin, you can directly trade in derivatives market. But of course, you should have a derivative privilege to trade into derivative market. I hope you will be knowing it. If you don't have derivative privilege, then I will also share the link with you. You need to first get your derivative privilege. You need to follow the link, whatever it is. You need to fill all the forms and upload the documents which is required, and T+3 days your derivative privilege will be activated and you can trade in derivatives market. So here I have taken an example. Suppose I want to buy one Nifty future where the margin requirement is 1,02,000. I don't have any funds with me. So that what I can do, I can pledge some of the shares, whatever margin I will be receiving it against it. I can basically trade in Nifty, take a long position in Nifty future. Our competitor do charge an interest cost of 18%, but we on an average of 18%. So suppose you hold with our competitor for 1 month, so your interest cost is 1,500 rupees is just your interest cost. But if you do the same kind of facility, we don't charge any interest. There is a 0% interest, and hence there is no extra interest charge which will be borne by you in case if you hold these positions by pledging of your shares. So this is the Pro Terminal gist of how it is useful. This is an advanced trading portal. You will get lot many analytical tools, ready-made analytical tools, wherein you can find your view based upon it. There are a lot of things which you can explore in our Pro Terminal. So you can just have a glance to it, and if you don't have, you can subscribe to our rupees 199 derivative plan. But before subscribing, you should be aware that your derivative privilege is activated. Then only you will get an access to Pro Terminal. And if you don't have brokerage of rupees 20 per order, then that brokerage will also be affiliated into your account. So that's it from our end. Now we will open this forum for a question and answer section. If anyone has any doubt regarding it, whatever we have covered, we request you to please note down, please give us the questions. There is a question link which is there in the top right hand side of it. You can type whatever questions you have. We'll try to address most of your questions. Firstly, let me just copy and paste the link to you all, so that if you don't have this derivative privilege, or if you want to offer derivative value plan, you can do it by subscribing from this link. I've also copy and paste the link in the chat box. If you want, you can just refer from our chat box also. So guys, if you have any kind of questions, well, please request you to type on their question and answer section. We'll try to reply you back. We'll wait for one more minute. If there are any questions, we'll just try to address it. If not, then we can just conclude. So I pasted both the link in our chat section. So is today's sessions recorded? It is not recorded, but you can find this session. We have taken this multiple session in our YouTube HDFC Securities. Under HDFC Securities, you can find a lot of YouTube videos which we have recorded, and you can refer it. Please describe balanced portfolio. I'm not sure, Mr. Dinesh, what you are talking about. Are you talking about mutual funds? Because it's a derivative session, so there is nothing in derivatives. There is as such balanced portfolio. Is it per month charge of annual charge? No, Mr. Jahidul, it is an annual charge. It is not a per month. Annual charge of rupees 199 plus tax. You will get an access to Pro Terminal, and also rupees 20 per order as a brokerage. So is the subscription charge for the first time users only? No, it's not. It's a subscription. It is for all of the users. If they don't have a brokerage of rupees 20 per order, first you check your brokerage, what it is. If you don't have that brokerage of rupees 20 per order, then you can basically avail this derivative value plan. And if you also want to get an access to Pro Terminal, then also you can do the same. So can I view on YouTube? Yes, as I told, you can just find our videos in YouTube. We have been uploading various videos on. We have also taken various webinars which were live on YouTube, and you can just refer to it. As of now, this is not live, and this is not there is no recording link of this this webinar. But there are various webinars which we have taken in the past where we have uploaded in the YouTube, so you can find that also. So you can find on HDFC Securities web page, HDFC Securities page under YouTube. You can find all the videos. So I hope there are no more questions. So shall we conclude? Okay, so there are no more questions. So we will conclude this session. I thank you all for joining in for this webinar. I'm sure this was quite helpful to you all to make you understand about various. We have one more questions. I have a suggestion. Please upload this discussion videos on YouTube channel also. Yes, sir. We'll take your suggestion and we'll try to upload it on our YouTube channel. Thank you. So yeah, thank you everyone for attending this session. I hope it was quite useful to you all to understand about various strategies, and I hope this will also help you in your day-to-day trading. So thank you all, and have a nice trading journey. Thank you.